All right, how's it going, everybody? So we're going to go ahead and test this audio real quick. I did my end, my back end testing. I always want to make sure you guys can hear me, so I'm not talking just a floating head with lips moving. So if anybody's watching this and you guys can just put into the comments, make sure you guys can hear me. All right, but we are going to kick it off. Welcome back to another Be More training. All right, we do this twice a month. It's the first and third Wednesday of every month, and different people come in and they just talk about something to kind of help you along within your business. A lot of it does pertain to real estate, but some of it may be financial advice, accounting advice, tax keeping, bookkeeping, all this good stuff, right? So there's a lot of variety in the topics that we discuss. However, today we're going to be talking about commercial real estate because that's what I do, right? So we're going to talk about commercial real estate, and not only are we just going to touch on what it is and what the purpose is, what we're really going to focus on is how do we get 100% financing for commercial real estate? All right. So for those of you who don't know me, my name is Michael Glaspie. I've spent several years in the military, several years in the real estate space, and I focus primarily on commercial real estate now. Not only do I do it as a practitioner and as a consultant for other investors just like yourself, I also own a lot of personal real estate, commercial real estate. I've been a part of hotel syndications, so forth and so on. I also have my CCIM designation. For those of you who follow the commercial real estate space, it is the international designation for commercial certified investment members, and where we focus truly on the commercial property as an investment and how that investment return looks like for us. Okay. So all of this information is coming from not only some practical use where I've done it myself, but also a professional side. Okay. So let's talk about commercial real estate just in general. Most of us should know what commercial real estate is. Commercial real estate, at the broad scheme of things, is really just your stores, right? Your buildings where people go in, your offices, your warehouses, things of that nature. But what I really want you to understand is what the definition of commercial real estate is. Commercial real estate is where the property is used with the intent for business, right? To actually sell a product or good. It's used for a business or a workspace, and it's not used for a living space for you personally, right? It's a business. So when we start thinking about what can be used as a business, let's just throw them out there, right? Yes, you have your retail space. That can be your Goodwill, your Dollar General, right? It could also be your restaurant space, if you will. It could be your Applebee's, your Starbucks, things like that. So that all kind of falls within that retail space. Then you have your office category. So the office category is just that. It's a place where people go and work. Now, yes, that can be an office that is for one specific company, or it can be even a shared workspace, right? Like a WeWork type of thing. Then you have your industrial. All right. Industrial is going to be your warehouse. Industrial is going to be your self storage. Think large businesses or aspects that have to do with the manufacturing, that has to do with distribution, logistics. That all kind of falls within industrial. And then the fourth one is actually multifamily, and most of you guys are familiar with that. Now, when it comes to multifamily, remember how I just said commercial real estate is used for business purposes and not for a living space, right? Well, I kind of try to highlight the fact that it's not meant for a living space for you, a place where you personally lay your head down, right? It's multifamily is not that. You're not going to be able to get a large multifamily. And now I'm talking 5 units and above, not 4 units and below, a large multifamily considered commercial, and you would be able to occupy it. Most lenders are not going to want you to do that, right? And so because of that, you're buying that property purely as an investment vehicle, or you're going to as a business, right? Because it is a full operating business. We have to be aware of that. All right. I'm going to pause right there just to retest this audio. Let me know if you guys can hear me. I would hate to just be talking and speaking. Give me 1 second. All right. I'm gonna keep rolling. If I see you guys' chat come up, then great. All right. So that's generally what the 4 components of commercial real estate is, right? And it's important to understand that because now you can put on the filter to see, like, hey, are we actually interested in commercial real estate, or do we want to stick with single family? Right. And there's no right or wrong answer. But if you guys are looking to get into commercial real estate, then this is what we're going to be discussing primarily today. Okay. So that is the general outline of what the commercial real estate space is. Now we got to look at how do we actually go out and acquire these properties, right? So when you're going out and get a loan, a bank is going to look at commercial real estate as a business, remember, because that's the whole purpose of commercial real estate. So now, well, if we go out and we get a loan on a home, yes, the home itself is going to be collateral, but the banks are looking at us. They're looking at our ability to generate income. On the commercial real estate side, they're looking at the property. They're looking at the property and its ability to generate income. So the bank is always trying to hedge their risk, right? Basically saying, if something went wrong, how do I get my money back, right? That's the bank's concern. So when they do this risk hedging, they're going to look at it from two different points of view. One, I'm going to not give you 100% of the value of this property. I'm only going to give you 70, 75%, right? Because if you have to sell, or if the property goes upside down, then we can still sell it and I get my money back. Does that make sense? So just like on the residential side, a lot of us may use the VA home loan, right? A veteran affairs loan with zero money down. That's a good thing. Or we might do something like an FHA loan where it's 3.5% down. If we don't have those type of government assisted ones and we're looking at an investment property, typically you're going to see 20% down. Why? Because the bank is seeing it as an investment or as a business, even on the single family side, but they're not willing to give 100% because they want to hedge their risk. They want to be able to see, hey, if you can sell it, I need to get my money back. So that's one component of it. However, there's another component of it. If you guys already operate in the single family space, what's common to hear is cash flow, right? This is a cash flow loan, right? This is hey, if you bring in this much money compared to the debt, then we're good. Well, it's the same thing on the commercial side. On the commercial side, it's called a debt service credit ratio. All right. And I'll put that into the chat just so you guys can see that debt service coverage ratio. See, I got two keyboards here, so it's messing me up. All right. Service credit ratio. All right. So with the debit, and I misspelled that, but don't worry about it. So the debt service credit ratio essentially says, what is my current mortgage payment, my monthly payment? That's all your debt, right? So your principal, your insurance, your taxes, and interest. I did that backwards. It's your principal, interest, taxes, and insurance, but nonetheless, it's your pity payment. Once they see what your monthly payment is, now they want to know how much cash flow in excess of that monthly payment do you have? So let's just say that your total monthly pity payment was $1,000. Okay. That's great. Now your cash flow, your rentals and everything, your other income is $1,500, right? So $500 more. Well, that ratio then is going to be 1.5, right? So your 1,000 to your 1.5 income, it's a ratio of 1.5. So your debt service credit ratio at that point in time would be 1.5. Most lenders are going to look at 1.2 or 1.25 to be their baseline. So the higher that debt service credit ratio, the more protection the bank has, because they see, hey, there's more money coming in. I know you can afford to pay not only for this pity payment, but more debt or operating expenses that come up as well, right? So the higher the debt service credit ratio is going to be important, and the LTV is going to be the other component. So let's think about it. If those are the two things, the LTV and the DSCR that the bank is concerned about, then let's look at how we can manipulate one or the other to really kind of maximize our loan capacity here. So if the DSCR goes up higher, meaning the cash flow is substantially more than the mortgage payment, let's just say it's a two to one, right? So the ratio would be 2. I'm making $2,000 in rent and my mortgage payment is only $1,000, and the bank only needs to see 1.2 higher. Well, now the bank sees, hey, there's so much room here. I might actually be able to increase my loan to value now because the debt service coverage ratio can cover it. right? So maybe now, because this debt service ratio is so powerful, now we can say, hey, Mr. Bank, instead of 70%, do you think I can get 80%? Right? And so now we're already seeing that the levers that we pull are going to play off of each other, right? So, and same thing with the LTV. If the debt service credit ratio isn't met, they may have to bring the LTV down until that ratio is met. So now we understand some of the levers, and now we understand the conversations that we can have with lenders to say, hey, let me maximize how much money you would give me so I don't have to bring much money out of pocket at all. All right. Now, the overall objective of not only this training, but in real estate, and just in general, not commercial real estate, but real estate in general, is how do I find the other money, right? So the bank gives me some money, but then there's this extra piece, the down payment that I'm required to bring, or the equity payment, right, that I'm required to bring. So how do I fill in the other money? How do I come up with that money so I don't have to bring in any of my own dollars? And that's what we're going to be talking about today, guys. So if you guys are still with me, we're going to get directly into these options. And we're going to cover some of these. So the option number one of how do I find that extra money to get to 100% financing is private money. Now, don't worry. I know private money often sounds overly used. And sometimes if we are not experienced in private money, then it can also sound complicated or far-fetched, but it's not necessarily the case. So let's look at private money and let's consider it as a loan or a debt first. What do I mean by that? Let's say we're in a conversation and I tell you, hey, I have this great opportunity. There's going to be this beautiful property. I just need $50,000. Okay. And if you give me $50,000 and in return, I will give you 8% return on your money and I'll have it paid back in 2 years. Okay. In that instance, it's a pure loan. You're just giving me money so I can then use it and then pay you back at a set time frame with a set specific return on your money. When you hear it like that, there's probably going to be more people who have money in their bank accounts and their retirement accounts, maybe in their life insurance policies that they can borrow against, something along the lines where they may not be happy with their returns currently in the stock market or in crypto, whatever the case may be, and say, you know what? Yeah, okay, I'll put my money with you. Why? Because you're giving me, let's say, an 8 to 10% return, and my loan is secured by the property. Great. So now you have this extra money come in and you can cover all the way up to that 25, 20%, whatever your down payment is. And so essentially you'll have it 100% financed. Part of it would be with a conventional lender, a bank or an institutional lender. And then the next part will be with private money. All right. It's just that simple. Now, when we think about private money as a loan, there's different ways that we can structure it. Okay. The first way that we just mentioned is 100% of the down payment. So that 20 to 25%. Another way to do it is to consider it as an 80-10-10, right? Or as mezzanine financing, which is going to be our next thing that we're talking about here. So mezzanine financing, just in general, so you guys know what mezzanine is. I want you to think of it as like the middle ground. All right. So let's just say you have a first floor and you have a second floor, but there's like this weird little something in the middle, right? Like a balcony or something for you to walk up. That'll be a mezzanine floor. It's the middle. So it's saying, how do I fill in the middle gap between what the bank gives me and what the down payment is, right? And so now I may be able to decrease my down payment from 25% to 10%, right? And I'm able to find another 15% through mezzanine financing. So that's what mezzanine financing means. So when we're talking about filling in with the private money, one common term or a common loan product that you may hear is an 80-10-10. Okay, where 80% comes from a lender, 10% comes from another source. It can be a secondary lender or it could be seller financing, and then 10% belongs to you. Okay, so that's where you have to bring in the 10%. The most important thing to understand about mezzanine financing is that it's typically going to come at a higher interest rate. And why is that, right? Because the first lender, the one who's giving you 80%, they're going to have first lien position on that property, meaning if anything happens, they get paid first and foremost, and rightfully so, especially if they're giving the bulk of it. Okay, so mezzanine financing is going to have a second position, meaning after the first lender is completely paid, then the mezzanine financier gets paid. So because of that, there's a little risk in that, right? And then because there's risk saying, hey, what if it goes down? First lender makes all their money, but I have nothing else to make, so forth and so on. So they're going to probably charge a higher interest rate, where you may be able to get in today's terms, a commercial loan for 80%, 7% interest. Mezzanine financing may charge you 10 to 12%. Okay, so that's important to understand. In addition to that, oftentimes they will have clauses that say the first lender has to be paid in full before you can ever make a payment on the mezzanine financing, right? So if let's just say it's a 5-year financing on the big loan, right, the 80% loan, you do your repairs in commercial real estate and you're ready to refinance. Cool. You have to pull out enough money to pay off that first loan first before you can do anything with that mezzanine, refinance, or even just make a payment on it. Okay. So it's important to understand those things. The last one that you need to understand with that secondary financing, private money or mezzanine, always remember the debt service credit ratio that we just talked about has to be able to support all of the debt on the property, not just one. So let's take that same example again, where I said the debt service credit ratio would be 1.5 if your entire mortgage payment was 1,000 and their cash flow was 1,500. All right. The bank feels good about that. But let's say now you add on this private money debt or this mezzanine debt, and now your total monthly pity payment is $1,500. And your rental income has not changed. It's still $1,500. Now, 1,500 to 1,500 in exact equal amount, that's a ratio of 1 to 1. Well, the lender is going to say, hey, look, I don't see my requirement of 1.2 on this deal. I won't approve for that secondary financing. You see the importance? You see the importance of having that debt service credit ratio really down and understanding how you can drive value through rents and understanding the impact of the financing. Okay. So now you got, 100% financing through private money. You got the second part for second institutional lender with mezzanine financing. And then we're going to go into the third aspect, which we talked about briefly, which is the seller financing. So in an 80-10-10, you could have that primary mortgage, secondary mortgage, and then 10% down payment. Or you can have primary mortgage, secondary seller finance mortgage, and then your down payment. Or you could try to mix them all and get 3 mortgages across the board, with that last 10% essentially being seller finance or seller carryback. Okay. Seller finance or seller carryback is just where the seller acts like the lender. So here's what I mean. Let's say we're working on a deal together and I'm selling it, you're buying it. And you come to me and you say, Mike, I love the property, but I can't pay you all cash for it right now. I'd like to take ownership today, and then I'll pay you back over the next 3 years. So, okay, well, I'm going to require a down payment myself. I'll require a down payment of $50,000. And then I want a certain amount of payments up until year 3. Well, then you'll pay me the rest. If we can come to that agreement, then you say, okay, and you'll start making payments to me directly, the seller, right? Because I am now carrying the loan as if I'm the lender. So that's what seller carryback means. But seller carryback can go in many different ways, right? So we talked about it we talked about it from the mezzanine financing section, right? Where we bring it as a seller carryback to cover our equity portion and a lender covers the rest. Same thing there. The DSCR still has to meet whatever the requirement is of the initial lender, right? Typically that 1.2 to 1.25. Or we can seller finance the entire deal from the beginning, right? And you don't necessarily always need a massive down payment. You can oftentimes seller finance for as little as just like 1 month's rent, right? And then just start making payments slowly after that. It's all up to negotiations, but seller financing is a very common way to start to acquire real estate, especially if you guys are looking at the upcoming the boomers, right? The baby boomers who've always operated at a mom and pop capacity, right? They didn't really scale. It's not really a professional environment. They just been writing their financials on a napkin and managing the properties themselves. A lot of times they're looking to retire, but they still want some of that income, but they don't want the headache of the tenant. Well, that's perfect. You take over the property, you take over the tenant, and then now you're just making those small payments, those incremental payments to the to the old owners, and now they can enter their retirement age with cash flow, with more residual income. So it's something that's very common. You should definitely consider. All right. Awesome. I appreciate it. Ruben says great content for starters. I appreciate it. Thumbs up to Yesenia, and then LinkedIn user. Awesome. I'm glad you guys are enjoying this. Okay. Now, so we talked about our seller carryback, and that's just that. Now let's talk about loan assumption. And I'm going to show you how we can kind of bring all of this stuff together also. So a loan assumption is if there's a property that already exists and there's a mortgage on it, oftentimes you can come in and just take over the existing mortgage and continue to operate the business. Now, why is this important? Well, because a loan assumption, when you do that, you're not generating a new loan. So you don't have to bring that 20 to 30% down. Okay. That 20 to 30% down on a $5 million property can add up very quickly. Typically during a loan assumption, there is a fee associated with it, but it's typically only 1% of whatever the current balance is, whatever the principal balance is on that property. So you can immediately see that a 20 to 30% down payment on a $5 million property, if you purchased it for $5 million, or a 1% fee on, let's just say, a $4 million loan product on that same property, is drastically going to be different in how much you have to bring out of pocket. The other thing that's beautiful about a loan assumption is, if you all are aware, remember that when we look at the amortization of a loan, right, we always start off where we're paying more interest than we are principal in the beginning. And only after time does it actually go to more principal and less interest. Well, with that being said, with you're doing a loan assumption, there's no telling exactly what phase of the loan it's in. It may have been a loan that was originated 5 years, 7 years, 10 years ago. So when you're acquiring the loan in today's time, we may already be paying more principal than interest. So we already get that accumulated pay down of principal. And so we can start paying less in interest over the life of the loan as well. So a loan assumption is very attractive for many reasons. Now let's talk about how we can start to kind of put some of these together. Now we got more options here for the 100% financing, but I want to get your creative juices flowing here. I'm going to give you a real life example for a hotel that we acquired at the previous private equity firm I was working with. There was a hotel where the seller was in a distressed position and they wanted to get rid of the property as easily as possible so they can focus on more of their assets. They weren't necessarily looking to get a great deal, but they wanted a fair deal. So their current loan amount that they had on the property was roughly about $600,000, and they wanted to walk away with roughly $900,000. Now, we had a recent appraisal completed on the property, and it showed the current value at $1.7 million. So this is great. So now we already, when we're thinking loan to value, we're essentially purchasing this property at 50% of its value. So no matter what we do on the LTV, we're going to be significantly lower than what's going to be required. So we kept that in mind. Then we looked at the cash flow. It was currently cash flowing very well. So we knew we had enough income to cover the current debt service and much more. After we started looking at that, we realized that the seller wasn't interested in taking the money out right away. They would actually prefer to have small installments made over time. So we said, okay, let's do a loan assumption of the $600,000 that was there. Let's do a seller carryback of $300,000. Okay. And then we'll take over the operations and move in from there. And I'm going to tell you the last little part here in a second. But what we essentially were able to do was acquire a property at 50% of value for very little money out of pocket, just the loan assumption fee, as well as some of the attorney fees. But I'm about to share with you at the end of this how we actually got those covered for free as well. Okay. So those are the start of some of them there. The next one I want to bring up is something like just call it an exchange. Okay. The one I'm going to focus on is the 1031 exchange very specifically. Now, 1031 exchange is where you sell off your current existing properties, but instead of actually collecting the cash and putting them in your pocket, you just roll over the proceeds into a new investment property. And by doing so, you now get to defer the capital gains tax on all of that profit, on all of that equity. So let's say you had a property that was worth $1 million when you bought it and you've done a lot of work and now it's worth $3 million, right? If you sold it, let's just say for simplistic numbers here, if you sold it, essentially they're going to say you made about $2 million worth of profit. So you have to pay the capital gains tax on that profit, right? Which is somewhere around 25%, I believe, today, right? That's the capital gains tax. So 25% on 2 million is a lot of money, $500,000. That cuts out a huge chunk of what you can take. However, you can say, I'm just going to roll this over into a new investment property, and I'll roll over all of that equity, that 2 million. Okay. And that 2 million will be my equity position on the actual other loan. So if a lender is willing to give you 80% on a new property, and all you have to do is bring 20%, sorry, but you bring over that 2 million, that means you can purchase a $10 million property with no money out of your pocket. All you did was roll over the profits to acquire this much larger property. Okay. So the 1031 exchange is very powerful for many reasons. Now, yes, it does require you to have some assets now. So it's not applicable for everybody, but it's something to keep in the back of your mind because it's a very common practice when people start to scale, regardless if they're starting with, the single family portfolios and building them up, right? Or they already have commercial properties. Once they have it to a certain point and they're ready to scale and kind of really focus in their niche a little bit more and focus on a larger, more centralized asset, 1031 exchange, just knocking at the door. Okay. So it's something to keep in mind there. All right. The next one I'm going to cover is the syndication model. The syndication model is a nice little secret sauce, but syndication in itself is also an entire venture that needs to be operated as a business. But let me explain what it is first. So a syndication model says, you and I, we know the property, we know the market. So what we're going to do is we're going to create a company where me and you are the general partners. We are the kind of the owners. We're the operators of the company. And we're going to go out and we're going to find real estate. Now, once we find real estate, good real estate that fits our criteria, well, we need to raise money to actually do the down payment, to do the project improvement plan, to renovate it. We need to raise that money from somewhere. So you and I, we can go out and apply for a loan, but there's also that down payment and equity position. Where are we going to get that from? So what we're going to do is we're going to syndicate, or we're going to go out and get a bunch of different limited partners. Now, these are people that have money in their banks, money in their retirement accounts, money in their IRAs, so forth and so on, that will put their money with us in order for them to actually gain ownership of the company, but not have any control rights of the company. Okay. Now, why would somebody do that? Well, one, they're going to get a better return typically than what they're already getting in the market, typically, right? But they also have the ownership, the benefit of ownership of real estate. Oh, I'm still here, guys. Give me a second. There we go. I'm back. They still have the benefit of ownership. And so what that means is now as the property depreciates, that limited partner can take all the depreciation and cut against their active income. So if these are high income earners, or maybe even they aren't, maybe they just want to pay as less in taxes as possible. Well, they get to now take all of that depreciation and apply it against their own personal taxes. They also get the benefit of appreciation. So what I mean by that is, yes, they're making a paycheck, or they're getting a return on their money every month, every quarter, twice a year, whatever the case is. But when it's time to sell or refinance, they also get to recoup on the growth of that property. So instead of a loan where they're only getting 8% or whatever the case is over and over again, they now get that 8% on cash flow and they get some of the profit, right? So there's a lot of benefits to that. And so what we're doing is we're providing that opportunity for them. They bring all the money to us and then we operate. Okay. And syndication is very powerful because it allows you to scale much faster. Now we can go out and purchase 1,000 units. Maybe say we got 1,000 unit portfolio now just by doing syndication. And in return, the syndicators, or the limited partners, they also own 1,000 units, right? But now we can go out in there and say we own 1,000 units, which is true, right? And we put very little of our own money into it. So now I'm going to tell you why syndication is the secret sauce. Yep. See, Regino knows it's all about the secret sauce, man. I'm going to tell you why it's the secret sauce. Remember that deal that I just mentioned, the hotel deal where we did a loan assumption and then we did seller carryback for the remainder of the purchase amount. So in total, 900,000 was the purchase, and we 100% financed that 900,000. Well, we still had a project improvement plan to do the renovations. We still had some attorney fees to handle the process. We had to do some operating expenses for the company itself, right? Not the hotel, but the company that owns it. So we decided to do a syndication. And so what we were able to do was bring in just a few investors, and we were able to raise all of the attorney fees, the project improvement plan, and so forth, and operating expenses. And we essentially financed about 100%. We were right on that, right on the cusp of 100% of an entire hotel that we purchased at 50% to value, 50 cents to the dollar. An amazing deal. But again, it's just to highlight that the creative approaches to combining all of these strategies together is really going to drive home that 100% loan to value. Okay, so that's syndication. We've covered loan assumption. All right, here's another. We have two more. Well, let me make sure we got two more. Yeah, we got two more. Now, these two are going to be a little bit more unique. Most of us haven't heard of these, especially if we're just starting. The first one is fun. I want you to first imagine this. Let's say you have a car or maybe a nice Rolex or a Garmin, right? Something worth of value, maybe a painting, the Mona Lisa. I'm not really an art fan, but you get my point. You have something of value in the house and you say, I really would like to buy this property, but I don't want to put my cash down. I'll tell you what, Mr. Banker, what if I give you this painting and this watch as my down payment? Can we get the property? And the banker says, yes. Now, how many of you believe that can be a true situation, right? I'm raising my hand extremely high because it is a true situation. That is called cross collateralization. Now, cross collateralization is just that. You're crossing over collateral from the primary property to something else of value. Okay. It's typically it's commonly seen. Let me put it like this. It's commonly seen in real estate where you may already have equity in a portfolio of properties, but instead of selling them and doing that 1031 exchange like we talked about, we just say, hey, no, I still want to own this property. I'm just now going to collateralize this portfolio, the equity in this portfolio, for the down payment on my next property. Very powerful tool here. So now we can actually go in and purchase another apartment complex, another mobile home park, another retail strip mall, all of that by keeping our portfolio in existence and then just cross collateralizing it. Now, with that being said, that's the most common way. But yes, if you had a valuable enough car, a valuable enough stock portfolio, something along those lines, you can always collateralize those as well to help you purchase that property. So cross collateralization is a very powerful tool that many people have not heard of. Brian says, what kind of camera is this? It's a Canon. It's a Canon EOS RP. That's what this one is. Can syndication occur with new development? Great question. Yes, syndication can occur with new development. It absolutely can. With new development in general, all that's going to change let's keep it general purpose, all that's going to change is the financial analysis and the financial distribution, right? What I mean by that is, yes, there is contractors, there's more site planning, there's more criteria as far as land preparation and so forth and so on. But when you're talking to your investors, if you're purchasing an existing commercial property, an existing 100 unit, 50 unit, right? Typically it's already cash flowing. So when you're presenting that opportunity to your limited partner investors during a syndication, you can tell them, hey, look, you're going to receive a distribution starting 3 months from now. Okay. And then you could rate that could be part of your pitch. In development, it's going to be a little bit different. The partners will not receive any distribution until the property is cash flowing. So how long is the development? The development can be 1 year, it can be 18, it can be 2 years. Okay. That's all fine and dandy. From the ending of development, when are you going to get it filled? Right. So typically you'll see in large development projects, they'll be completed in phases. Phase 1, phase 2, phase 3. And once the first phase is complete and the second phase is initiated, they'll start to try to occupy that first phase because they want to have some sort of cash flow coming in. But until that development loan product is essentially paid for and you're out of that bridge loan because it's typically short term. It's never 7-year, 10-year. Well, let me never say never, but it's typically a short term, 1 year, 2 year, 3 years. Once that's satisfied, then you can go into long-term debt, your 10-year, 15, 20, 30, and you can really start to see some of the cash flow from there. So the conversation just differs with your limited partners, but it can absolutely be used for development as well. All right. And then Regino asks, for syndication, what is the general percentage of ownership for that investor? Great question. So if I understand your question right, you're saying what is the general ownership for the limited investor, right? And so this is how it typically breaks down. When you look at the property itself, you typically have a 100% of the pie, all right? Somewhere between 20 and 30% will be cut out for the general partners, right? That's me and you, the ones who are finding the property, operating the property. We're going to keep 20 to 30% for ourselves, all right? So that means 80 to 70% is typically going out to limited partners. Now, the question becomes, how much does each one of those limited partners get? Well, let me ask you this question. Do we feel like it's fair that if somebody put in $50,000 and somebody else put in $5,000, that they should get an equal share, right? The answer for me would be a hard no, right? Because obviously somebody's putting up more risk, so they deserve more reward. So the way it breaks down is out of that 80%, we've already allocated exactly what we need to raise out of that 80%. So 80% of the equity that we're giving up may be $1 million in value. Okay, great. So now if you gave us $100,000 or $150,000 or $10,000, we're essentially saying, what is that $10,000 compared to the 1 million that we raised? What's the equity percentage there? And then that represents the true equity percentage that that limited partner owns. So hopefully that makes sense. Okay. All right. Awesome. All right. So we're going to keep going. So we cover cross collateralization. Again, cross collateralization is one of those bangers. Many people don't realize it, but it's very powerful. The only other thing I wanted to highlight is, since we are using them as collateral, whatever that may be, right? The portfolio that we own, or the artwork, or the new car, because we're using it as collateral, if the main property fails, that means the bank gets to not only take the main property, but they also get to seek those items that were used for collateral to make up any difference if they lost money. So just keep that in mind, but it's still a very powerful tool. And the next one, this one is a big one. How many has heard of the SBA loan, Small Business Administration? All right. Hopefully some of you have. If you guys haven't, I highly recommend you guys go and check out www.sba.gov. Man, I got these two keyboards, man. They keep messing me up. sba.gov. Boom. All right. This website is literally designed for small business owners. When we say small, we're not talking about the large publicly traded companies like Apple, all that good stuff, right? We're talking about the small business owners like ourselves, right? The private owners. They have a lot of resources for us. They have resources for business planning and, development, for coaching on entrepreneurship, for training on how to hire, just an abundance of resources. But one of their main resources that they're known for is their loan product, the SBA loan. So I'm going to hit you with the real banger here in a second. But what an SBA loan has is essentially, it says, we will give you 90% loan to value on what you need for your business. Okay. Now let's think, if we're owning a business, let's keep it within the real estate space. Let's say it's car wash. It's a car wash. Okay, great. Well, we go in there. It's a business that comes along with real estate. So maybe I can buy the property because that belongs to the real estate, but maybe there's more equipment I need for the car wash. Maybe it's a vending machine to try to increase revenue. Maybe it's a new system for collecting payments, or a new system for the actual car wash itself. Well, the SBA loan is saying that you add all of that up, and we're willing to give you 90% of that entire purchase price. So that's pretty powerful. That is pretty powerful right off the bat. Now, the reason I chose a car wash, you might have heard me say it, is because it's a business that comes with real estate. So let's think about that. When it comes to commercial real estate, remember, we just talked about most banks, most lenders are only going to give you that 70 to 80% tops, typically, without having to do something to fill in the gap. But this lender, the SBA lender, is willing to give you 90%. Already a huge difference. So the beautiful thing is you can use that 90% to buy that real estate that comes with the business. And you can also do everything we just talked about for that other 10%. You can also do your seller carryback. You can also do your mezzanine financing, private money, so forth and so on, cross collateralization. All of these things you can do with the SBA loan. So let's think about this. We just talked about boomers, right? The baby boomer generation ready to sell a lot of their investment properties that they may have. Well, what about the baby boomers who are actually owning and operating businesses? Now, let's talk about businesses with real estate, and let's just kind of cover a few of them. We talked about the car wash. What about dry cleaning services? A lot of times they come with buildings, with properties. Self-storage. Self-storage is a sexy trend right now. A lot of people love the idea of self-storage. Well, guess what? Self-storage is an industrial real estate product, but it is owned and operated purely as a standalone business. So now you're talking self-storage you can put in there. You can have maybe a cleaning company that has a small, and not dry cleaning, but like a true cleaning company, like a corporate cleaning company, right? And they may have an office there. All is a real estate office, real estate brokerage may actually own the real estate potentially, and then they operate out of it. So you can go in with the SBA loan and you can say, hey, I want to buy this entire operation here, including the real estate, and only bring 10% down. And if it's a baby boomer, right, that's owning and operating it, or somebody from that generation, they may want installment payments, right? So maybe you can sell or carry back that other 10%, and boom. Now, there's some downsides to the SBA loan as far as timeline. Okay, so it's not as quick as like a 30-day loan. The SBA loan is definitely a 4 or 5, 6 month process potentially. So you have to be ready for that. But that's also part of buying a business. Buying a business generally takes a little bit longer because there's a lot more due diligence involved in that, and a lot more transition training that goes along with that as well. So you want to keep that in mind. Also, they're going to deep dive into all the numbers. The SBA is going to make it's just not, no shade to lenders out broker, mortgage broker myself. Now, a lot of times when the information comes in, we can look just at hard, fast facts like, our rental income, tax, and we're good. Well, with the SBA loan, they're going to try to look at all the contract agreements that you have for clients, for customers. What's your potential generated income for the rest of the year? What have you reported over the past 3 years? How much is actually going to salaries? How much is going to office expense, so forth and so on. And then they're going to want to have a plan that shows, okay, what are we going to do to actually increase value? So down to the actual details. Well, we intend to bring in 2 vending machines that'll generate here. We actually will have an on-site office that sells packaging supplies, so forth and so on, right? So there's a lot more detail that goes involved into it, but it's very powerful tool that most people, one, have either never heard of, or two, typically just don't explore, and they absolutely should. Now, here's the kicker. Here's the one I wanted to give you. This is for all our veterans out there, all of our active duty and prior service veterans. The SBA loan also has a product specifically for you. It's called the VA SBA loan, or the Veteran Affairs Small Business Administration loan. The beautiful thing about this is that it is also a 0% down loan product. Okay. And it still goes through all the stipulations that a regular SBA loan does as far as the amount of detail. But now it's telling you that you can buy a business and the real estate associated with it for 0% down. This is the one method out of everything that we discussed that can be a much more guaranteed path, right, towards that 0% down or 100% financing. There's one major kicker I want to highlight with this, though. Although it sounds sexy, it has a limit to how much the purchase value of the property can be. The limit right now is $350,000. Okay. So it is a smaller loan size in the realm of real estate, just in general, especially in the commercial space. But don't let that deter you away from potentially doing a car wash or a small self-storage center or a dry cleaning business or whatever, all the things that we just discussed at a smaller scale, because you may be able to generate that SBA loan at 0% down. And guess what? If you found another car wash, another self-storage, now that you already own one and you're operating, it's going to be much easier to get that SBA to approve another one, and then another one. And then once you have a portfolio of those that you put zero money down on, you can now cross collateralize into bigger opportunities, right? So there is a ton of ways to get 100% financing on these properties, as long as you're using a creative approach. Okay. Now this is the last part here, and I'm sorry I'm messing with this earpiece here. It keeps falling out my ear. All right, I think it's in there now. All right, so the final piece I kind of want to leave you all with is, how do you know which aspect, which one of these loan products or options or strategies is going to be right for you? And it's just a simple approach to it. I'm going to keep it very simple. Yes, it can be hard or not necessarily easy if you don't know where to go, but it is a very simple process in general. So the first part is you need to speak to lenders for clarity. All right. What do I mean by that? If you want to do a loan assumption, what lender do you think you need to talk to? Do you need to talk to a new lender, or do you need to talk to the existing lender for that property? Right. The answer is the existing lender, right? Because you're coming in and you're assuming that loan that's already in existence. So with that in mind, you need to talk to that lender. You can talk to them as a seller. You don't have to talk to them about that loan, but you need to talk to that lender and say, hey, look, I'm looking at assuming one of your loans. I just want to know what's the general process. Well, how are you going to qualify me? What do you need to see from the property itself? What are the fees associated with it? Great. You need to gather that intel. Now, what if you're purchasing a property? Same thing. You need to contact an attorney, contact a lender that you intend to purchase for that property. So what does that mean? Some lenders love multifamily. Some lenders hate car washes or self-storage. So you have to find the right lender for that product type. And you need to find more than one, because not every lender is created equal. And you need to ask them, hey, what needs to qualify for this loan type of product? What do you need to see from the property? What do you need to see from me? What type of experience? What type of cash flow do you need? What's the debt service credit ratio? What's the maximum loan to value? What do I need to qualify for that maximum loan to value? All of these questions are going to help you gather information. Okay. Same thing with your private lenders as well. Hey, I have opportunities come up all the time in real estate. Are you interested in? What would you be looking for out of an opportunity for me? Okay. Safety, security, great, guaranteed money back. Okay, cool. All right. Now, once you know that, now you can start to piece those puzzles together as the opportunity comes across your lap, right? So now the property comes, you're analyzing it, and you already know how you need to run the numbers to see if it can be financially feasible for any of those lenders or a combination of them all. Okay. For your private money, I want everybody to be aware of this. So I've done several private money investments in the past. I've actually lended money, I've borrowed money, and a lot of the investors within my inner circle use a lot of private money. We'll all say this. Everybody who has done private money will tell you the same thing. Just because 100 people raise their hand and say, yes, I would be interested in an opportunity, does not mean 100 people will give you the private money. There's a difference between those who have verbally committed and those who will actually put in the money. So you need to make sure that you're having several conversations with your private money lenders. You're doing the follow-ups. You're understanding their timeline, their price requirements. And once the time comes, you really need to prime them and say, hey, look, if I needed the money in the next 2 weeks, how much would you be able to deliver? Right? We really need to get into the mindset of how much can you guarantee? What I would recommend, this is a number that a lot of us use. It's not necessarily an industry norm, but I would say 20% of the people who said they're going to give you money will actually give you money. I know it sounds scary, but keep that in mind. So what does that mean to you? your Rolodex of private investors needs to be substantial, and you need to nurture those relationships. You need to consistently call them up, provide value, right? What can you do for them? How is their situation going? Financially, their financial position may be changing constantly, right? Things happen that we can't necessarily predict. So as you're nurturing those, you're constantly farming that group to make sure that they have some money to commit when the opportunity does arise. All right. All right. Pete says, will this be available as a recording? Yes, this should be available as a recording. It should be. I apologize. I don't really know how StreamYard works. I'm hopping on my buddy Ruben's platform right here and doing it on some of my channels, but it should be a recording. You should be able to find it on my YouTube channel, at least at Michael S. Glaspie, CRE Made Easy. Or we talk about commercial real estate. So yeah, matter of fact, if you guys aren't there, you guys can go in and subscribe, and you'll see a lot more videos about commercial real estate topics very similar to this. Okay. Oh, here's another one, guys. Another little tip. You want to actually speak to the city that you're investing in. That's right. Speak to the city, because a lot of times the city themselves will already have economic development plans, essentially saying the city knows the path that they want the city to grow. And so many of us have heard of gentrification. Well, that's essentially the process of the city pushing development through areas that need to be revitalized, right? That need to bring in more income, bring in a certain demographic, bring in more jobs, provide housing for more jobs, all of this stuff. They do that not only on the residential housing side, but they do that on the commercial side as well, right? They're constantly trying to bring in new business. So when we talk to the city, we can talk to the Economic Development Committee, and that name may change from city to city. But when you talk to the Economic Development Committee, we get an idea of, are there any new features that we need to be aware of? One common one recently is the opportunity zones, where if you create an opportunity fund, you can now invest into these zones tax-free, right? Beautiful thing for people that have the wealth and have that capital that they need to protect. There was also, for a small stint in time, in one of the cities I invest in, there was actually a grant, a revitalization grant of $10,000 that can be used for the exterior beautification of a property. So if it's already a property that you're intending to flip, right, or do some development on, well, great. You go in and spend the money on the inside, and then you get this grant for this free $10,000 to put towards the outside, right? And yeah, you had to show receipts and all that, but the city is constantly giving things for what they want you to do. It's just like Tom Wheelwright says in Tax-Free Wealth. It's a great book if you guys haven't read it. He always says, if you want to know what the government wants you to do, read the tax code, right? Because the government will give you money if you're just doing what they're asking you to do. And so it's the same thing with cities. And then, and then the last one, guys, is just tell everyone about your opportunity. A lot of people may be intimidated with asking for private money. I know I was personally, and I'm sure just like you guys, we felt the same way. If we're starting something new, then it may be intimidating just to cross that threshold, just in general, right? But it helps when you change your mindset to say, I'm not asking for money. I'm presenting an opportunity to you. And let's think about it. If you knew that you could help out somebody that you cared for, your family members, a loved one, and you said, look, man, if you put $10,000 in this, I know you're going to make X amount of money, and this is going to set you up right. I know this $10,000 can make you $300 a month for the rest of your life. Right. And now I'm over embellishing here, but if you had that opportunity to present that to somebody that you cared for, wouldn't you feel obligated to present that opportunity? If you can change your mindset to say, this is not an ask, this is an opportunity, it'll allow you to go out and start to tell more people about your opportunity. Hey, I have another investment. It's an opportunity for other people to get involved with what I'm doing. And, it's somewhere around 8%. You can perfect your pitch from there, but it's an opportunity to get involved with what I'm doing. It's an opportunity to make more money on stagnant money. It's an opportunity for you to put that money in your savings account, and it's something that's secured by a real asset. Once you can change that mindset, you need to tell everybody, because you will be surprised at the people who actually do come and give you the funds, right? It's people that you may not have much of an engagement with, but they've been following you for quite some time, or they've been seeing what you're doing. It may be a loved one. It may not be a loved one. It may be somebody, just from high school is just like, I always do, is going to do something. right? You'll be very surprised. So keep that in mind. And you want to make sure that you're telling everybody about your opportunity. All right. All right, guys. That was the end of my presentation. Essentially, what I had to bring about how to get 100% financing in commercial real estate. Again, remember that summary is really about combining the creativity here and using a bit of all of these different methods to get to that 100%. I want to end the presentation on this, essentially, that you can truly do whatever you want to do. You just need to figure out the how. Okay. And once you figure out the how, if you decide that you don't want to do it because it's just way too much stress and effort, then that's fine. But I implore every single one of you to find the how. Figure out how it needs to be done before you turn it down. Just that journey alone of figuring out how it can be done, you can always extrapolate small pieces of the process and come up with your own beautiful process to be productive. Okay. But you have to continue to use creativity, kind of go back to that elementary lifestyle, right? Our adolescent lifestyle where we could just imagine ourselves being superheroes and imagine ourselves traveling through space. That's just me telling on myself, but you kind of get my point there, right? Allow that creativity to be present today as an adult, as a professional, while we're looking at real estate solutions or any solutions for that matter. If you guys have any questions, I'm going to stay on for a few more minutes. I'll stay on for about maybe three more minutes or so. Yeah, and we'll kind of go from there. Just make sure I didn't miss any of these messages. I'm glad you guys could hear me. And to touch back on one of the questions here about will this recording be available? I'm sure it will be. We can actually, I tell you what, it will be saved to StreamYard. I do know that for a fact. So if it's not available, just feel free to reach out. Best way to reach out to me right now would actually be on the YouTube channel, Michael S. Glaspie, CRE Made Easy. That's going to be the best opportunity because it's least congested. So you can just reach out to me there and ask for the video recording and we'll get it pushed up. Hey, Jade. Absolutely. My pleasure. I'm glad you were able to attend. I'm just going to put the YouTube channel there. It's a new channel, but we're putting out a video a week. So to keep the volume going there, keep the value going. And Jade is one of our outstanding agents located in the Fayetteville area. Okay, so the question here says, do I assist with syndications? Oh, I'm still here, guys. Sorry about that. So as far as me personally assisting, I'm gonna lean towards no here, and the only reason why is because assisting is a broad term, right? What I mean by that is me personally, I'm not a syndication attorney. I'm not going to come in and give you legal advice on how to file with the SEC and things of that nature. I have done several syndications though, and I can provide direction on how to file those SEC filings, your Form Ds, the different CRMs or software tools to use for your investors as they come in, presentation pitches, all that stuff I do have experience in. That is not one of my consulting services, although since you ask, maybe I should add that to the docket, right? And I do offer consulting services for financial performances on not only your real estate investment, but also on your real estate business as a whole as well, regardless if you're doing syndications, private equity, rentals, so forth and so on. So that's kind of where my ballpark lies. But if you are interested in syndications and a few more people show interest as well, I can absolutely start to design a consulting program around that. Any other questions? I have about 30 seconds I'm showing on my timer because I'd like to get off right at Oh, maybe, yeah, a little bit longer, but I like to get off right at 10 so you guys can go right back to crushing the day. I'm trying a new camera setup, so hopefully this one is coming out well. Just working on it. All right, guys. Well, hey, I greatly appreciate the time. I greatly appreciate you guys coming and spending some time on a Wednesday morning with me with your coffee in hand, right? I hope you guys have a great rest of the day. And if you guys need anything, have any other questions, please feel free to reach out to me. Like I said, right now, the best way to reach out to me is going to be through the YouTube channel. However, you can just send me an email directly as well, and I'll be able to get to that fairly quickly. All right. Awesome. Thank you guys so much. See you next time.